Welcome to today's newest Sovereigns podcast. My name is Joan Feldbaum-Vidra, and I look after sovereign ratings at KBRA. Today, we'd like to discuss China with you. We've all been assaulted by headlines on China these days. They're hard to ignore, even if we wanted to, which of course we don't. China, as our listeners know, is a critical engine of the world economy. It's also an important geopolitical player on the international arena, and on top of that, it is a source of global risk. Hence, the Sovereigns Group follows developments in China pretty closely. Before we kick off these musings, I'd like to invite the listeners to check out a few recent pieces that KBRA has authored on China. Two of the more recent ones discuss China's assets, which are copious, and its liabilities, which are also copious. Anyway, those pieces provide good background about China's influence on global risk. And given the importance of commodity prices to economic and financial conditions across the globe, China is something to monitor and understand, especially given its voracious appetite. Now, on that note, yes, China no longer records 12% growth per annum, but it is projected to grow by north of 5%, even by some of the more bearish of the observers. And given the size of that economy, let's say about 14 trillion in total size, we're speaking in nominal terms of adding $1 trillion of demand to the global economy every year. That's not small change. Now, some China critics will mumble about the inaccuracies in measuring growth in China. I do think we'd all agree that China is no longer growing at 12% a year, but it is probably growing around 5 to 6% or so, considering comparisons with other emerging markets, and especially given the debt-fueled growth binge that China has undertaken as of late. So there are two things to unpack in our musings on China's policy shakeup and credit implications. The first, China's slowdown. Now, what are we talking about here? Let's put this into perspective. You'll observe that this is the same dynamic that we're witnessing in the United States. Partly, this has to do with the stage of the cycle of recovery. After a rebound, there is generally some sort of plateau, but the slowdown also has to do with consumer and business confidence. And the second thing to unpack in this musing is, and it's interrelated, it has to do with the possible slowdown that's coming due to a recent flurry of policy action that's rather negative for growth, in KBRA's view. China actually grew in 2020. It's one of the rare examples across the globe, and largely this was due to its success on the social distancing front in China and its ability to contain the virus. It did shrink by 6.8% in the first quarter of 2020, but ever since then it has been growing. The rebound peaked in the first quarter of 2021 with an 18.3% surge year over year, and then decelerated to a still attractive 7.9% print in the second quarter of 2021. But that print, at least for some, was weaker than some onlookers were hoping for. And more recently, the latest high-frequency indicator prints point to continued weakness in the third quarter. Flooding is added to that as well. Those high-frequency indicators were for retail sales, industrial production, and fixed investment. Some major investment houses have lowered their growth estimates, and the IMF also revised its growth estimate downward for China. In its April forecast, it predicted 8.4% growth for the year, and now it's revised down to 8.1% for the year. That may be optimistic. And built into that estimate, the IMF estimate, is likely monetary accommodation, meaning further cuts in the RRR and maybe even rate reductions. So what is underlying this momentum, and why is KBRA concerned? Okay, so first, we've underscored that those recent slowdown dynamics are partly due to the stage of the cycle, but what worries us more is the impacts on confidence that we're seeing. Consumption in China accounts for about 55% of GDP, but investment accounts for about 45%. China is currently getting hit on both fronts. And that brings us, in our musings, to the policy front. This is a two-pronged discussion. The first thing to think about is China's financial stability priorities. And the second has to do with China's priority of having a strong state. First, financial stability. Well, as we all know, China has built up a lot of debt over the years and also had to add to that debt in order to deal with the COVID pandemic. So China has recently been trying to withdraw from that debt creation policy stance, and actually this has rippled through the economy through a series of defaults. What we're seeing here is just the tip of the iceberg on what's going on in the economy in terms of unproductive enterprises and a lot of unproductive investments. There's a lot more route that we don't know about, as it's probably negotiated behind closed doors. There was a recent property developer default, a coal producer defaulted right before Christmas, and China has been withdrawing stimulus at both the central government and the local government level, clamping down on LGFVs, which are local government financing vehicles, and all of this means that credit's been tightened. And in that environment, what concerns get hit the worst? The smaller guys, the small and medium-sized enterprises, SMEs. And that explains the recent relaxation or lowering of the reserve requirement ratio, the RRR, that we've seen, that I referenced before. And there's probably more to come on that front. And those small and medium-sized enterprises, well, of course, they're employers, they're enterprises or businesses, but they're also households because of the people they employ, right? There's the confidence and spending factor tied into those recent data points, and that's where the consumer comes in. Now on to the second point in our musings about policy. This has to do with China's priority for strong state politics. The recent headlines that involve major regulatory actions that really aim to change the way business is being conducted in China, well, that's about the big state and preserving the power and influence of the big state. Clamping down on after-school tutoring, raising information requirements, scrutinizing use of data, ensuring for minimum wages, and a lot of activity focused on China's digital champions that generate about 40% of products. Well, a close watch on fintech activities and abuse of market powers is also part of this. And all of this is happening alongside China's development of a central bank digital currency. And that's all about big state. It's about a concern that China has that the private sector, that private enterprise is getting too much power. And this big state philosophy is also guided by external security concerns as well. China, policymakers in China, I should say, are concerned about too much foreign involvement. And that is the point of the clampdown that we're seeing on variable interest entities, VIRs. These are vehicles that oftentimes the business sector uses in sectors where China limits foreign ownership, usually for security reasons, such as telecoms and education, and foreign investors participate through shell companies based in jurisdictions that are offshore. So to wrap up our musings, what are the credit implications of these dynamics? The growth slowdown, the alleged hit to investors. Investors may be befuddled by the recent adjustments in policy and the abrupt U-turns, and they may become more cautious. On the other hand, households and the population in general may be lifted a bit by some of these dynamics, like the lowering of the RRR and some of the income supportive measures that have been introduced. KBRA is concerned that the hit to investment will overwhelm any positive impulses to consumption if they were to arise. In KBRA's view, China could find itself growing out of its debt burden, yet even slower than originally expected. Thank you very much for joining us for today's podcast. Please reach out if we can answer any more of your questions. Have a great day.